Thanks for letting me be a few minutes late. So we're going to walk through some of what's happened since the December call. And I would say that it's been a really fascinating month of things that we did not expect and surprises. So let me just share a couple things with you. First of all, you guys can see my screen. Give me a thumbs up if you can. Okay, looks like you can. If you have questions, Kennedy, will you watch the chat just in case someone has a question? The good news is we've got a pretty good number of people on, so I just want to make sure I don't miss anything. Goals for this series, I really have three goals when I think about these state of the market economic update calls. And first of all, it's really to help you understand the numbers and the metrics that drive our business both locally and nationally. And you go through periods where you think, man, this industry got hard, especially for those of you who just got in the industry particularly the last 2 years. This has been one of the most challenging periods that has happened in a long time. And in fact, when you look back, we're really into our third and now going into our fourth calendar year of the lowest home sales in U.S. history. And well, I say that it's the lowest home sales in U.S. history when you look at it based on population growth. If you take population growth out of it, it's the lowest home sales since 1995. So even when you think about 2008, the challenges that we've been through, the recessions we've been through, this is still a very difficult period. So first of all, we want to help you understand what are the markets, how do they affect you in your business? We want you to be able to follow economic trends, and economic trends tell a story. History tends to repeat itself. So when we understand what's happening in the trends, we can do two things. We can predict something that's going to happen in the future, and we can also prepare our business. So we can, when we know we have to hunker down for longer, then that means we may need to double down on our lead gen or do additional things. And then lastly, it's really being able to be the economist of choice, which is what the Red Book says that you want to be for your clients. So how do we take this data, help them make informed decisions, help them make smart timing moves, all of that type. So those are our three goals for this series. Before we get into this, I want to hear from you guys and love to hear from a couple of you. What is it that you're currently experiencing in the field, even from December to January, or just currently in general? What are you experiencing? Who'd be willing to share?
I'm experiencing no showings on my listings. Came out, I don't know if everybody else is, and I've lowered prices and made modifications to my marketing. I don't know what else to do.
Yep. And price adjustments, that's your best thing. And Tom said low showings. It was an interesting year this year. The Thanksgiving, Christmas and New Year's fell in the middle of the week. And seasonally, we always know that the listings data, the new listings data, the new transaction data, we usually throw those weeks out anyway. This year, it exacerbated that trend, and I think that it really kind of carried over into early January, and we just haven't seen that pick up. But yep, low showings. Who else?
Condos with high fees have been a real challenge to get people in the door, even to look, even if they're at an extremely low price and low for the condo community and the market itself. It's still, people don't want to pay those high fees.
Yeah. The interesting thing is the results of the condos that came down in South Florida. The impact of that in terms of the requirements to do additional structural inspections I believe it's every 10 years now. I know that I happen to live in a condo myself, and our monthly dues just doubled. We went from about $900 to about $1,800 a month. So that and insurance are the two factors that are really impacting the Florida market heavily. And then when you look nationally, we'll talk about this a little bit when we get into the national numbers. Right now, inventory in the U.S. has grown substantially, and it's actually a very healthy thing. We're still not where we want to be, but we are where we are, better than where we were in 2022. But you have markets. I just got off the phone this morning with an agent from Arizona, and he said, man, stuff's still flying off the shelf, multiple offers, like it's crazy. We have low inventory. And then you've got states like Texas and Florida. Currently, Texas and Florida make up 10% of all U.S. inventory. Those are the two states that have grown in inventory the fastest. Other states like Vermont, some of the Massachusetts, New Hampshire, that area is still very, very low inventory, sometimes less than 1 month of inventory. So it's a little bit of just a tale of two stories. Okay, let's dive back in. If anyone has anything else they want to share, just pop off mute and interrupt me. Okay, so let's go through the next slide. Some of you guys asked me where these slides come from. I take the data from National Association of Realtors. I use a data service called Altos, and I also use Trading Economics, that website, a lot. So let's take a look, U.S. economy, what's happening. Okay. Okay, next slide. There we go. They all went at once. Okay, so here's the story this month. In December, as we were rolling into December, there was actually some very positive news that we felt was on the horizon. We had a Fed meeting that happened in December. We also had Jobs Week that happened at the beginning of January, and of course, last week we had the incoming new administration. All of those things kind of added up to give us a mixed bag that we did not expect. So we're going to talk a little bit about Fed comments, a little bit of inflation data, and some unemployment to be able to watch for. Now, all of this correlates around what we call the federal funds rate. And I think it's one of the least understood aspects of the interest rate environment. When agents and consumers hear that the Fed cut rates, they have the perception that, hey, that means interest rates are going to go down. And the Fed has two goals. One is maximize employment. So they want to make sure that employment is growing year over year. They want to maintain stable prices. They want inflation to be at or around 2% year over year. Now, they adjust the economy, or I always think it's, I describe it as you're trying to drive a car and you got like a piece of floss tied to your steering wheel and you're trying to steer. You can move things, but they just don't move very fast. And it's a little bit hard. You're going to overcorrect and you're going to undercorrect. And that's what the Fed does with the federal funds rate. So it's always a moving target. The rate is really the rate at which banks lend money to when they have excess cash or when they need cash overnight. Now, there are some, let me admit someone here. We just went through a period where we had 11 increases in 18 months, which was the fastest increase in the federal funds rate dating back to the 1980s. And you'll see here in February of 2022, we went from 0.25%. We increased our first increase to 0.25%. By July, we were 5.5%. Realizing that they did that to combat inflation, the question that we're gonna have on the backside of this is, did they overcorrect, and is their current tight policy going to keep us in a more depressed state for longer, or are we going to come out of it? And the interesting fact is that currently the housing is one of the very few sectors that's in a recession. We've been there for about 2.5, 3 years. Many other sectors, financial sectors, are just having robust years. And so it's this battle between our industry that needs things to change and come down, and other industries which are on fire, that if the Fed overcorrects or undercorrects, it could benefit us and it could impact the rest of the economy. So when we look at this, this was the fastest increase since 1980. And when we look back in the 80s, that Fed funds rate was raised from 1979 to 1980 from 10 to 20%. These were the days when mortgage interest rates were as high as 18%. Then we came back down from 20 to 8.5%, from 81 to 82, and that's supposed to be 1982. Of course, we all know that after COVID, we had some really loose fiscal policy, and that really meant there was a lot of money chasing too few goods in the market, especially with the demand shock that we had post-COVID, trying to get stuff and then trying to buy stuff and make stuff. So rolling into December, it was expected that we were going to see somewhere in the neighborhood of 4 to 6 rate cuts in 2025. And this is where we were on our last call. That would be about 100 basis points, which would take us somewhere in the 3.25 to 2.75 federal funds rate. That's not interest rate, that's the federal funds rate. We'll talk about how those correlate again here in a moment. That was the expectations. Boy, did we get a little bit of a surprise. We were expecting, on last call, we were sitting at about 6.625 on an average 30-year fixed rate. Last call, we were projecting these would get into the fives, and it could be anywhere from 5 to 5.875. Now, by the way, historically, we know that when rates come down for an extended period of time, they typically have to move 1% or more. If they stay there sustained, you will have a bump in housing. So if we could get into that sixes and just stay in that low sixes, we'd see an increase in transaction data. If we get into the fives, we would really, anything a 5 handle on the interest rate is going to really spur activity, and it's going to pull some of those. We've had 3 years in a row where we've had 1.7 million fewer transactions than we should have had. So those rates would pull some of those. I'm not really a sideline buyer person. It's more of an affordability, but it would bring the affordability down, and we would have more transactions. Well, December the 18th, we got some good news. The Fed decided that they would do a 25 basis point cut. And so we did get the cut that we were looking for. And that was very quickly covered up like a wet blanket by what transpired that same day in that same meeting. So the interest rates going in there were at 6.6. And now, let me get back over here. There we go. That 25 basis point brought us down to 4.5% on the federal funds rate. Jerome Powell, who's the Fed secretary or the Fed president, he gave this statement afterwards. He said, we are significantly closer to neutral on interest rates, and we think where we are is meaningfully restrictive. I think from this point forward, it's appropriate to move cautiously and look for progress on inflation. Now, in the economic world, we talk about being hawkish or being dovish, and this was a very hawkish statement. This is hawkish means it's restrictive, or that they're going to, the forward guidance that they're giving us means that they're going to hold interest rates higher for longer, which is not what we want for our industry at all. Now, he went on to say, as for the economy, the Fed chair said that the central bank has, quote, done a lot to support economic activity by cutting 100 basis points. And he added the outlook was pretty bright, but most forecasters have been calling for a slowdown in growth that keeps not happening. This has really been the last 6 to 8 months. We keep expecting the inflation rate to get under control, the labor market to start to break a little bit. It just hasn't. And so that better than expected data just keeps us in this higher rate environment. Now, how this affects you guys is that as a real estate agent, the federal funds rate is correlative with the federal with 30-year fixed rate mortgages, but it doesn't trend right along with it. What does trend, you'll see here, this is a slide from last month. The gray line is your federal funds rate, so the overnight rate that banks charge each other. You'll see the blue line is your 30-year fixed rate. As the fund rate goes up, it starts to affect the treasury, the 10-year treasury, which is the benchmark that the interest rates are linked to, that your 30-year rates are linked to. So you have this concept of a spread, and I'm trying to keep this as easy as I can. And if you take nothing else out of this call, it's really what we're experiencing right now is a widening of the spread between the 10-year treasury and the 30-year fixed rate mortgage. And this is what you see when you look at the correlation. You'll see that the 10-year treasury tracks almost verbatim with 30-year, because typically most mortgages are priced based on a 10-year treasury plus some kind of a margin. typically it's anywhere from 1.5% to 2%. But the last couple of years, we've seen margins or spreads being closer to 3%, which has had a really, really big impact. Now, here's the next thing to happen that same day. The Fed released what they call the dot plot. And because I'm an economics geek, I watched this. So don't read anything into this except that if you look going into December, the pre-December 18th, the other Fed members were expecting, you see those red dots. Those red dots recommend, say, here's where each Fed person thinks forward rates are going to be. These are the projections where we think we're going to be by the next year. Well, you'll notice a lot of those were in that 3.5 to 3.25 range. Well, they surprised us in December with this commentary, and the other Fed members increased or decreased the targets for the future, which puts us more in a 4.25 to 4% range, which would be somewhere in the neighborhood of 1 to 2 interest rate cuts next year. If you look, I didn't highlight this on here, but you see the red dots. The red was last year, the pre-December 18th meeting. The blues are after December 18th. You can see by the time we get into 26 and 27, particularly 27, you can see that they're all pretty much in agreement that we're going to be down in that 2.75, 3% range. But it's going to take us longer to get there than what we wanted. And this was not positive information for the housing market by any stretch of the imagination. By the way, there's some good things happening, so this isn't all doom and gloom. You'll see that 2026 went from about 3 to 2.75. Now it's at about 3.75, so about a point higher than what we were expecting. That day mortgage rate shot up, and we saw mortgage rates go to over 7%. And if we look at it here, you can see this increase that we experienced right here in December. Things just shot up. Now, I don't know about you, but I kept feeling like, hey, there's a light at the end of the tunnel, and it just didn't come. And it probably will still come, and it's a challenge. So this is how this looks today. I mentioned earlier that the average 10-year Treasury, there's about a 1.5% to 2% spread. At the height, we were nearly 3%, and that's where we saw the 8% interest rates. And this is, I think this is the other thing to take away today, is that yesterday, the 10-year Treasury was sitting at 4.64%. Traditionally, that's a very high 10-year Treasury rate historically. The 30-year fixed rate yesterday was 7.08. This is an average. You don't really get a 7.08. You get a 7 or a 7.125. And so the spread was 2.4%. The good news is that if some of the economic data could just calm down and we quit getting these like really crazy beats estimate reports, we actually could see interest rates come down by about 0.75 of a point. That would put us into the 6s, maybe even the low 6s, and that would be a very positive thing for the market. And as long as it stayed there longer, we actually would see a bump in housing growth. At the worst, if we were back where the spreads were at closer to 3%, we'd be at 7.7%, almost 8% interest rates today. So this is where the silver lining is in there, but we still have a little bit of a ways to go. We could be anywhere from 5.9 to 6.4 with typical spreads. Then December 18th happened. Then we had Jobs Week in January. Initial jobless claims came in at 218,000. It was better than expected, which means that the economy is growing, it's expanding, it's still very hot in terms of the growth, the expansion. The expectation was 217, and again, this sent bond traders into a frenzy. Job growth, we also had 180,000 projected new jobs. The actual was 256,000. And that also beat expectations, which also had a challenge. And then lastly, inflation. The headline reports in January came in at 2.9%. And if you remember from the beginning, I said the Fed wants to keep rates, wants to keep inflation at about 2%. This was the highest inflation since July 2024. And that all came together to create this mixed bag of things that have happened. The last thing that's really happened this isn't a direct impact, but this is something that we're watching a little bit closer, is that we obviously have a new administration, and every administration has its own stance on fiscal policy, on trade policy, on domestic affairs, international affairs.
I'm excited.
Trump did actually put Jerome Powell into the Fed chairman position. However, they did not see eye to eye during Trump's first term. Jerome is still there, and he's slated to be there through May of 2026. So the question is, does he bend a little bit of a knee and have a little bit more less restrictive policy based on some of Trump's pressure, or does he withstand any pressure? Trump has said very clearly that he wants to see fiscal policy loosened. So, this is something to watch. I think it's going to be an interesting brouhaha to see how the two of them get along together. Then we have a couple of other nominees that are important, and one's particularly fascinating. And I call these all Trump factors. These are the things that are happening that have direct influence in our industry. Scott Turner was the HUD Secretary nominee. Scott, many of you guys remember when opportunity zones came into play, and Scott was the one that actually came up with opportunity zones. This is a very seasoned veteran that is very pro-housing, that has historically always supported very positive efforts for our industry. And he also has really good supports on both sides of the aisle. So from the standpoint of Scott, I think this would be a very, very good nominee to have in there. The other one is the FHFA nominee, Bill Pulte. That's the grandson of the founder of Pulte Homes. And Pulte is also very, very, very good advocate for our industry. And he's also historically, the involvement that he's had has always moved things in the right direction. So these are two very positive nominees that I didn't expect it to be different, but it's always interesting. Now, here's the one that is interesting, is that CFPB, Consumer Protection Finance Bureau. We currently have no nominees. And that is because Trump has rumored around cutting the budget to eliminate the agency. The CFPB came into effect from the Frank Dodd laws back in 2010. We got qualified mortgage at the same time, but they've been they're kind of a scary agency, to be honest with you, because they really have a little bit like the IRS. They just can kind of come in and start to mess with you a little bit. And so this would be an interesting development for our industry. It would restrict, or it would loosen some of the really heavy restrictions that we've seen over the last decade. This was also an interesting discussion because Vice President Vance, his background is in antitrust. And so there was a little bit of nervousness, and still is, that antitrust factor could still be coming down from the top. And of course, we've seen this in our settlement lawsuits. That was an antitrust issue. We National Association just lost their appeal for the Justice Department to reopen the investigation that they said they were going to close. So I think it remains to be seen, but it's kind of fascinating that we don't have anyone, and we'll see if they do cut this agency or not and where that goes. You guys heard yesterday, Trump proposed some tariffs on China. There's a lot of discussion around the fact that tariffs and similar policies are inflationary because it brings up the cost. When you go back and look at Trump's first term, he really was very careful that he made sure that the economic policies were really strong and that the underlying fundamentals were in place as they should be before he introduced tariffs. So much like positioning in a real estate transaction where the other agent calls and says, how'd your client like the house? You go, I don't know. It showed okay, and your client's excited as all get out and running back to the office to write an offer. Some of this is just about posturing to get better deals, and so I think that we'll watch this closely, and it'll be interesting to see how it plays out this year. But I don't foresee this being a massively inflationary item that as we go into the year. A couple of other things just to watch for. There's been some proposals to increase capital gains. And of course, capital gains have been, we're not linked to inflation. So it's been 250,000 capital gains exclusion for an individual, 500,000 for a married couple or one tax return. The proposal would be to increase this to 500,000 from 500,000. Sorry, from 250 to 500 and from 500 to a million. And this would allow us to see less taxes on some of these high-end properties that have appreciated. And these are the last two statistics on this I want to leave you with. When you look at the last 5 years, the average appreciation of U.S. homes has been 41%. The challenge is that the average wage growth over that period of time, the increase that the average salary went up was 14%. When you do that math, that is a big delta between the two. This is why traditionally you want to see wage growth in line with inflation. And when housing prices are at 2, 3, 4% increase every year, and wage growth is in 2, 3, 4% every year, your affordability or your buying power stays very consistent. Really, when we talk about the rate lock-in, it's not so much that we have people that are at low rates, which we do, but it's more of the affordability factor that's keeping people from jumping back in. And when you look at someone that's looking to downsize from a larger home to a smaller home, I know I just had an agent that shared this with me the other day. They're downsizing, their payment was still going to double, even going down from where they were. And that's a real factor. So it relates to an affordability issue. And I showed the slide last week also, or last month also. When you look at since 2021 through 2024, the average monthly principal and interest, it's 72% higher housing cost. And when you look at the amount to qualify, it's a 46% increase in income needed to qualify. And of course, we just said that incomes have gone up 14%. This is a challenge. This is going to be one of our challenges. So where does this leave us for projections for 2020? This says, 2024. Where does this leave us? Well, 2024, it looks like we're going to end the year. We're going to get this data here in just a couple days, but it looks like we're going to end the year at about 4 million. We were concerned it was going to be 3.8 million, but we're at about 4. Not a great year, not a worst case year, but certainly we would like to see that inch up into the high 4s, low 5s. Last month, we were expecting to see more of a 4.5 to 4.7 million sales pace. Based on everything that we're seeing now, it's looking like we're maybe going to see a 5 to 7% increase, which means 4.2 to 4.3 million residential resales. The message in this is really that it's probably going to be a harder year than some of us wanted, and being able to get close to your database, doubling down in your lead generation, doing the right activities is going to be the difference in you having a good year personally and not. And the reality is that in our Tri-County area, we had 52,000 total transactions last year. There's more than enough for you to get your unfair share, but we have to have the activities, the mindset, and the skill set to be able to go do that. So let's dive into some of the national housing market so that we can look at what's going on nationally. Pulled this data from Altos. So currently, the little chart that you see down the lower left-hand side tells us, based on the economics, are we slightly into seller territory or slightly into buyer territory? And nationally, we still have a slight seller's advantage in the marketplace. Now, what's important to know about the Altos data is that this tracks every home for sale in the US every single day. The reason I use this data and why I bring it to you is that the National Association of Realtors data is typically about 90 to 120 days old by the time that it comes out. 3 months can make a huge difference in how you look at the numbers and what you're seeing. So this is literally every single week up to the date, up to the moment. Median list price nationally, 419,000. Median price of new listings are about 409,000. The average days on the market, 120 nationally. So this is the US market. Median sitting at 84 days on the market. Price decreases are 33%. We're going to look at a couple of these. Price increases, those are usually new constructions that saw a price increase, or your crazy seller that decided it didn't sell at that price, so let's raise the price. Those are the ones we want to get rid of. Increased by 3%. Relisted, new inventory getting relisted. This is the time of year we have a lot of expireds coming back on the market, 10%. And then inventory, we're going to talk a little bit about that. Median rents, when you look at rents are starting to fall a little bit across the US, but they are still very high relative to other periods. So the rents are an interesting factor. When we look at this versus last month, you can see median list price. The right was last month, the left is this month. Median list price has fallen a little bit. Of course, median is you take all of the prices and you find the very middle. And so the median is about 5,000 less than it was last month. That doesn't mean that prices are going down. That just means that the pace at which sellers were pricing their houses are flattening out. So the market is still increasing. We're still seeing appreciation. We just don't see 10, 12, 15, 18, 20% like what we were seeing. We may be more like 1 or 2%. And the challenge with that is sometimes it's hard to get your sellers to understand, hey, this isn't 2022 market, certainly not spring of 2022. So when we look at inventory, one of the silver linings in this is that the inventory growth has started to put us back into a healthier territory. And we talked about this a little bit in December. In the US, we typically have anywhere from 1.2 to 1.4 million homes for sale. And in March of 2022, we hit the all-time record low of 240,500 listings available for sale in the US. That was a crazy time. That's when, of course, we were seeing 10, 12, 15, 20 offers on things, and you just couldn't put your hands on inventory. If there's something that's positive that's come from the last about 18 to 24 months, it's been that inventory growth has continued to increase, and that means you have more optionality for your clients. It does mean that as the markets improve, little over 80% of all buyers bring a listing to the marketplace. So that means that as things pick back up, we're actually going to see that inventory continue to grow and continue to build. So we're currently at 632,000 US listings, and that's down just a little bit from November when we were up into the 700,000 range. I think we were at 713. Days on the market, you can see the trends. July 8th, 2022, we had the lowest days on the market in this last 5-year history, 54 days. We're currently at 119 days on the market. So we're back to that, 4-month average time frame. Properties with decreases, this is an interesting one to watch, and this is also interesting when you really look at it in terms of our market here locally in our Tri-County area. Price decreases, we saw the low hit of 16.6% in March of 2022. It's an important number to know, but typically about 1/3, right, about 33 to 35% of all inventory in the US takes a price reduction. So when you see something in the 30s, you know that, hey, that's pretty typical market. When you see 16%, that's a savagely unhealthy market. And when you get into the 40s and the 50s, like what we were last month, you realize there's a lot of price corrections going on. So the good news is nationally, we returned to a little bit more of a balanced market in terms of price reductions. Now let's dive into local markets. We'll start with Sarasota County. You'll see that this is the first time we've seen the market action index actually move into buyer advantage space. So the market action is 29, anything below 30 says buyers have a little bit of a competitive edge. And last month, someone asked about the months of inventory. Part of the reason that the Altos data is different than some of your local data is that Altos takes out the new construction that you can't really go buy today. Many times you can buy a piece of new construction, but it's going to take 6 months or 9 months or a year to build that property out. So this looks at what can you go buy and move into in a 30, 45-day period of time. You'll notice some of the trends on the right-hand side. Median price has stabilized a little bit. Average days on the market, 115, so we're about 5 days less than national. And price decreases, though, are still in that higher level. So let's dive into this a little bit. Currently, most recent available data was January 17th. There were 3,960 homes that were available in Sarasota County, up from a low of 328 in 2012. And that number it's just a crazy number. So we're more than 10 times increase, which again puts us back into a lot more healthy market than what we were in. We look at average days on the market. Currently 114 days average, 90-day moving average has been 120. That's up from the low of 37 days. Now, these are really great tools to, after the call is done, I will send these out in a PDF format. These are great to print off and put in your listing binders and really even talk to buyers about some of these numbers just to help guide them in making the right decisions. When we look at median list price, you can see right now we're at $489, 7-day average. We were January 1st, 2021, we hit a low of 409. That was, of course, that COVID period. And then we hit a high of 699 in March of 2022, right before things, of course, took a turn. So 489,000 were a little higher than the median in the US, but still not bad. Properties with price decreases, this is one that we've seen fall a little bit from up in the, we were up in the 50s here. Let me just do one thing here. We were up in the 50s. We've seen this come down to the 40s, but we still have some room to go. And I'll be honest with you, I think there's still a lot of overpriced listings out there. And it's funny, I did have an agent, bless her heart, she, during the heyday of 2021, 2022, she said, someone said I need to take a price reduction, and I don't know what that means. And my aha on that was there are people that came into the market in that period that just haven't truly had those skill sets. And not a bad thing, it's just a reality. They haven't had those skill sets of having those tough conversations with their sellers. And, you know, I think back to the 2008 to 2010, 11 timeframe, many times, if you were in the market back then, we would take the first 4 or 5 price reductions actually at the listing table. So it would say on this date, we're going to go to this price. On this date, we're going to go to this price. It's not a bad policy to bring back, or to at least be at the listing table having the conversation about how the market works, and the fact that if we're on the market for 30 days, or we have an average of 7 to 10 showings and no offers, those are both an indication historically we need to adjust that price, and it probably needs to be a 5% or greater reduction in order to be able to move the needle. So price decreases, let's jump down to Charlotte County. Look at our friends down to the south, and a lot of this is for our coastal living Inglewood group. Median list price 416. You can see that we are in slight buyer advantage. We've got 27 market action index, which is actually indicating that the buyers are getting, we've moved a little bit into a buyer's market in that Charlotte County area. Taking a look at some of the inventory trends. Currently, Charlotte County has 3,180 listings available as of January the 17th, I'm sorry. That's up from that low in June of 2021 of 282 listings. When you think about 2 large counties, we had less than, that would have been just over less than 600 listings in that 2021-2022 period in those counties. It's just crazy. So we are seeing the inventory starting to climb and get back to not where we'd like to see it, but getting back to a more stable level. Average days on the market, we're sitting at 139. So that's taking longer for properties to sell. That's where you see that buyer having a little bit more of an advantage, a little more negotiation power, because if the seller needs to move on, they might be willing to take a price that's less. Median list price, you can kind of see the trends here Charlotte County is sitting at about 416 median list. We had our high in May of 2022 at 530 and our low 274 2020. You look at that 2020 to 2022, that's a 200 and some thousand difference, 270, 370, 470. Yeah, it's like $230,000 increase just in that period. Just fascinating to see that trend. But of course, this is also a good slide to use for sellers to understand that the market that we were in at that time is not the market that we were in today. Price decreases, we're sitting at 41%, so we're very similar to what we were seeing in Sarasota County. Then when we go down to Manatee or go up to Manatee County, median list price 539, so a little higher. Median list price of new listings, however, 475. That may be an indication of the amount of new construction that's still sitting in that marketplace. Days on the market, 101. So we are still in a little bit of a seller's market in the Manatee County area. Let's dive into inventory. We're sitting with about 2,600, so about 1,000 listings fewer than Sarasota and Charlotte County, but up from that low of 268. So that would admit that all three counties have less than 1,000 total listings available during that period of time. It's just it's a shocking statistic. That's what we call a savagely unhealthy housing market. So inventory is growing. Let's see. Median list price, 539 currently, down from the high of 857. But again, you see that pricing trend that just shot up during that 2021-2022 period. Price decreases, we're sitting at about 40%. So we're still over that 33 to 35% level. So we still have price adjustments happening. I think we're going to see that level out a little bit as new listings hit the market. But of course, new listings can hit the market at lower prices, and that causes existing sellers to move down. So it takes a little bit of time for that to shuffle through. I'm going to come off and just say that it's going to be an interesting year. We really want to see that 10-year treasury settle down. We want to see those interest rates get back into that sixes and stay there for longer. And so I would say that this is a time really truly double down on your lead gen, stay very close to your database. This is a great time for every person in your database, make sure that they know what their current equity position is. And I call it a home equity analysis as opposed to a CMA. Update them what is their current market value of their home. There are people out there that think that the market's terrible. There's still people that think the market's fantastic. And the reality is it's kind of somewhere in between. We'd like to get out of the recessionary time. Couple of things that we're going to be watching going forward. I did not put this in here, but it could have an impact. The Department of Government Efficiency, DOGE, Trump has indicated that he's going to make some massive slashes to the federal workforce. And you saw there was an executive order issued to require employees to show back up to the office. One of the factors that's buried in that policy is that if we do see a lot of government workers fired, that would push the unemployment rate up. It would push initial jobless claims up, and that would actually be good data for the housing market. Now, bad for them because they lose their job, but it would actually be something that could impact us. So we're going to watch that a little bit closely, and then separately, then we're just going to continue to watch those 30-year the 10-year Treasury and our best laid plans. But our hope is that if we can just get some of that economic data to settle down, and we can see those spreads improve, we can see those rates get back into the sixes, and that will spur us on. The reality is we're going to probably still muster through a little bit of a challenging year this year if we're at 4.4 million sales. On the backside of that, 2026, 2027, 2028, 2029, we're setting ourselves up for a fantastic run. We just have to weather the storm and get through this. So with that said, I will open it up to any questions, comments, anything that we can answer for you that you guys might wonder. Sue, Loretta, Tom, Lisa, anything stand out to you? Sue, you're muted. And I saw Tom came off mute also.
Hi, Brian. I was just wondering about, based on all of these numbers, should we expect to continue to see prices go down over the course of 25?
Yeah, that's a great question. We're projecting that we're going to continue to see house prices appreciate. It's probably going to be more in the 2, 3, 4% range. So there isn't any expectation that prices are going to go backwards, barring some major issue. But we will see those appreciation rates continue. But the pace of price growth is what we're seeing taper off. So where people were used to 5, 10, 20%, we're not gonna see that for a little bit. It probably will be a couple of years before we see that again. One of the other factors, and I'll go to Susan, one of the other factors that is a real factor right now is that we've seen new multifamily starts. The permits for new multifamily starts are actually at a recessionary low. And so as the multifamilies have gotten built out, and that's typically a 2 or 3 year cycle to start construction, build them, and then bring them to marketplace, you're starting to see people not building, or builders not building additional new units. And we're gonna watch that closely. If the job market were to start to break, that would be good. You'd see initial jobless claims in the 320,000 or above range, and that's when we would see those rates come down fast. The California fires are a wild card because those type of events are kind of a stimulus package in so much as it brings builders, it brings employees in, it does a lot to stimulate the economy. So that's going to be a factor to watch over this year and see how that impacts that labor data. Susan.
Yes, I want to know your thoughts about the impacts of Helene and Milton here, because there's a lot of people just getting their house redone and gonna sell. And I mean, it floods the market. It's tough. I mean, there's going to be other things causing people to sell, but also it impacts people who want to buy.
It does.
A decrease in buyers because of that.
Yeah. Anytime you have those natural disasters, and hurricanes are certainly one of those that follows those trends, you tend to have about a 2-year cycle where it takes about 2 years for the pace, the repairs, all of that to stabilize and come back into the market. I think hidden in that question is the question of what's going to happen to insurance rates. When you look at the insurance markets in Florida, we have some challenges that we're facing. And that all comes back to affordability. And it could be that over time, those insurance rates just hold while insurance rates go up, it may hold prices more steady. It's possible they could go backwards. I don't foresee that, but it's a real factor. And of course, as someone said earlier, the condo market with your condo fees, it's the same thing. Those are the 2 biggest wild cards for us.
Right. Well, same. Thank you.
Yeah. Yeah, and I live out on Longboat Key, and I was looking through the MLS the other day, and every second listing had no drywall in it. It was just people that either didn't have insurance or were underinsured or don't want to deal with it and just walked away. So gonna sell. Good question. Anyone else? Questions, concerns, curiosities? All right, you guys are a quiet bunch today. Well, like I said, stay close to your database. This is a great time to really reconnect. Focus on your lead generation, focus on your do the database 2 connections, and we'll see what January rolls up to be. Next month, we will have Gary's vision speech slides that we'll be covering and going into some deep dive on. We'll probably pull some absorption rate data, so you've got some absorption rate in there. So appreciate you guys. Go make it a great day. Go serve your clients, and you are our greatest asset. And we appreciate you all being here.
Thanks, Brian.
Thanks, everyone.
Thanks, Brian.
Cheers. Of course.